Steve here. The ledger is officially open. Look, while the retail crowd is out there chasing shadows on their social feeds, getting high on pure hopium, we are looking directly at the tape. Today's explainer is all about separating the noise from the cold, hard print of Friday's close. Let's get right into it.
If you're trading on a prayer this morning, you're the one being traded. I've been doing this a long time, and I'll tell you the one constant. The market, it's a highly efficient machine literally designed to transfer wealth from the impatient right into the pockets of the disciplined. You don't trade on feelings, guys. You don't trade on some geopolitical rumor you skimmed on a blog just hoping to get lucky. No, you trade the numbers in front of you, period. So let's take a look at the verified reality of the Friday session.
All right, here is your morning ledger. And man, the bulls really staged a massive ambush at the bell today. We saw the indices absolutely rip higher as the algorithms reacted to a labor report that came in, well, quote-unquote, just right. That plus a geopolitical narrative that was shifting by the hour. The S&P 500 closed up 0.84%. Brent crude reclaimed some serious ground, settling at $101.73. Gold caught a solid bid, up 0.72%, and Bitcoin, it finally snapped its losing streak to stalk that 80,000 level again. But listen to me, don't let these green screens intoxicate you. We've got to look at the actual levels underneath. Check out the structure of the S&P 500 here, finishing at 7,398.93. It was flirting heavily with that 7,400 level all afternoon. It was an absolute grind, but the bulls actually managed to hold the tape into the weekend. But notice the extension here. Rallies built on algorithm reactions to macro data, they can evaporate just as fast as they form. And algos, they don't have loyalty. You need to understand exactly what drove them to aggressively hit that buy button this morning in the first place.
Now, buying pressure, it came straight from the red folder. Non-farm payrolls hit the tape this morning, showing 115,000 new jobs. That completely blew past the consensus estimate of 55 to 65,000. Meanwhile, unemployment held steady at 4.3%. Honestly, it's a highly resilient report. But here is the real kicker, the exact reason the market rallied. Wage growth was tamed down to 0.2%. The Federal Reserve has been begging for a cooling labor market, and what they got was a stable one with suppressed wage inflation. For the algos, it's literally the Goldilocks print. But while retail is out there buying the very top of this squeeze, I really want you to see what the professionals are doing behind the scenes.
For my friend Milton, and anyone else out there getting a little dizzy at these market heights, you need to look at what the smartest money in the room is doing right now, not what the talking heads on TV are saying. $397 billion. That is the size of the cash fortress Greg Abel just reported in the first Q1 report of the post-Buffett era over at Berkshire Hathaway. I want you to let that number actually register for a second. Nearly $400 billion in dry powder. That's monumental.
And when we dig into the filings, we see Berkshire wasn't just sitting on old cash. They were a net seller of $8.1 billion in stocks this quarter. Abel isn't buying into this tech-heavy squeeze at all. Actually, scratch that. He's actively selling into it. He's totally content to sit on the sidelines, earn a guaranteed 5% on treasuries, and just wait for the market propaganda to fail. So ask yourself a very simple question. If the Oracle's successors are hoarding cash at these historic levels, why on earth are you fully leveraged on margin?
And the propaganda I'm talking about, that's the geopolitical ledger. The physical reality over in the Strait of Hormuz is a far cry from the victory post you see floating around on social media. Despite all this talk of a one-page memorandum of understanding, the independent maritime trackers are showing near-zero commercial movement. A potential agreement doesn't clear a physical minefield, guys. Insurance firms are flat out refusing to cover hulls until the ink is completely dry and those mines are swept. Furthermore, we are in the final window of a 48-hour ultimatum. Trump presented a one-page deal to Tehran to gradually reopen the strait. If they don't sign it, the threat to take out the Iranian domestic grid is basically the only card left on the table. Meanwhile, Iran just spun up a brand new government agency to vet and tax vessels. Tell me, does that sound like the behavior of a state getting ready to surrender control? No way.
So this leaves us staring down two massive, sharply diverging realities by the time the bell rings Monday morning. First up, you have the bullish view, what we call the peace dividend. This is the pure hopium bet that the one-page deal gets signed, everyone holds hands, and the strait reopens. If that actually plays out, yeah, for sure, S&P 7500 is a lock, and oil crashes right back to the $80 handle. But then, there's the bearish view, the ultimatum trap. This wager assumes Iran's new transit tax and the stalled shipping lanes are basically a middle finger to the deal. If the bombing resumes or, God forbid, a guided ship hits a mine tonight, well, $101 oil is an absolute bargain. We'd be talking about $150 Brent crude by the time you pour your Monday morning coffee.
Look at this.
The professional energy pits are sending you a very clear message right now. Brent reclaimed ground, holding support right here at $101.73. If oil is staying above $100 heading into the weekend, it means the professionals are entirely rejecting the peace narrative. They aren't buying it. They are pricing in the very real risk of the ultimatum trap. Trust the oil traders on this one. They're the guys moving the physical product, and they usually know the ugly truth long before the equity markets ever do.
So here is your professional trading directive as you study your charts this weekend. Ignore the noise. Watch the levels. First, keep your eyes glued to the Aqua 20 Simple Moving Average. The S&P is way overextended right now. If we gap down below 7,350 on Sunday night, the relief rally is officially over and the trap has been set. Second, trust the energy pits exactly like we just discussed. And third, keep those safe haven positions tight. Gold holding a floor at $4,722 is screaming at you that the big institutional players are still heavily hedging for a worst-case scenario.
The tape doesn't lie, and the ledger absolutely does not wait for latecomers. If you're carrying risk into this weekend, you had better have your sizing small and your stops exceptionally tight. Let the amateurs gamble on the weekend headlines. We trade the reality of the print. So, as we head into Monday, I want you to ask yourself a serious question. Are you reading the tape, or is the tape reading you? Stay disciplined out there. This is Steve. The ledger is closed.